All right, we're ready to start here in week 10. Note, I've got the class session page brought up, and in this week 10, we're going to combine it with week 11. So chapter 6, homework and discussion board won't actually be due until next week, week 11. But what we're going to do today is go through the half, because it takes quite a bit more time to go through chapter 6. It's one of the more longer chapters, more detailed, about owning your own small business and how to do the tax return. But the first thing we're going to go through is what is due this week, is the basic VITA certificate, and normal Tuesday deadline at 8 a.m. That's the first thing I'm going to touch on. So let's, when you go into the class sessions, what I would do is bring up the VITA review document. We're also today going to go through, of course, the lecture notes, and we're going to hit this U.S. tax court case. So we're going to hit that. I'm going to make sure to have that up on everybody's class sessions by the end of today. So let's jump into the, I want to get into the VITA site. When you pull up the VITA document, there'll be a link. I know you can't see it right now, but I'm not going to switch back just to show you the link. When you open up that VITA document, there'll be a link. And I'm going to now go to that link. I'll paste it in. When you copy and paste it, this is what you'll find. And I hope that some of you were using this for review for the midterm. I think this would have been a great help. I will pull up, if you would go to, say, like the dependency exemptions here. I think you can see this. So I just pulled up, I just randomly went in here and I went to page 36. So this gives us an example of, can we claim somebody as a dependent? And if you go back some of the pages, it'll say, well, you have to provide over half their support. So then the question is, well, what consists of support? They give us a little example here, and this is how they teach throughout this, these pages here. And at least for me, this is a great way for me to learn. I usually don't learn as well just through definition. I learn through actual examples. So when they say this individual received $2,700 from Social Security, 300 he put into savings, so he only spent 24 on his own. So he actually spent 24. That's what we're going to count. What did you use for your own? And then when this individual who takes care of him spent 26, thus she spent over 50% because he only spent 24, she would meet the test. And then it goes on and gives another example. And it keeps giving different examples with different amounts. So we have to decide, does this individual have the support that it takes? I think those examples are great ones to go through. And when you've gone through most of those examples, what the next thing that you're going to do is go to this certification test. Just scroll down the link a little bit and click on the test link, leave the IRS site. And as you'll see in that VITA document that I have there in the week 10-11, you will need to set up, create an account. And then when you create the account, you'll have your own login name and password. And then that's where you'll actually go in and take the test. And it'll tell you some different, let me, I don't remember my login off the bat. But when you go in, you'll see, it's pretty self-explanatory. You should be able to figure it out. But make sure you do create a new account. That is one of the things you need to do. And you will have to take an 10 question on ethics, basically, on what you do in certain circumstances. And then when you get to the basic, it'll be approximately 25 to 30 questions. And you have to get, I believe it's 75%, maybe 80%, I can't remember off the top of my head, 75 or 80% correct in order to pass. And if you pass, you'll get a certificate, and then I basically give you all points. So even if you got 83%, it's like you got 100% when I see the certificate. So read through that. That's how you'll go about getting into the VITA site. and actually taking the test. And then when you get to the test, click on the print when you see the certificate. If you pass, click the certificate, act like you're going to print it. You actually won't, and then at that point is where you can save your certificate and then attach it in Blackboard as part of the assignment. I'm only requiring you to do the basics this week. By week 14 and 15, we'll look at the full advanced part as well. So you'll have 2 certificates, the basic and the advanced. If you want to start the advanced, that's fine as well. All right, so let's, I'm going to get back out of here. And now I'm going to go ahead and pull up my notes. All right. So business income, we're looking at Chapter 6 in the book. The first thing I wanted to just bring to everybody's attention is the difference between the Schedule C and the short form, the Schedule C-EZ. Schedule C-EZ is very similar to like a 1040-EZ, where for those very basic filers who have their own business, you can file this much, much shorter form, and it doesn't go into near the detail that Schedule C would. But again, it has to be a pretty basic type of business. So not very much expenses at all. Basically, you're looking at a service type business because you can't have any inventory. You didn't have a loss, which hopefully most businesses don't have too much of a loss for very many years. Only owned by one person, so it's not a corporation, it's not a partnership. No employees, so that takes out a lot. I mean, employees has a lot of different things that have to go along when you have payroll expenses that have to come out, so that becomes more complicated. You don't have any assets that you're taking depreciation on, so that's again a person type service business. So a lot of things is just for the bare bones business. The second thing I like to look at when I'm thinking of a business is what you have really a business, or should it be more classified as a hobby? And there is good and bad about both. And sometimes it's better to have your not occupation, but your income generating activity actually be a hobby. As you'll see here, if you have a hobby, bad part is you can't deduct any expenses, and I mean any of them. Even if you are, say, an art person, an art dealer. You buy some art, or you buy the canvas and you paint on the art, and then you turn around and sell it, you would have to record all of the proceeds, but not any of those cost of goods sold, like the canvas that you paid for, or any of the art supplies, like the paint or the oils. You wouldn't be able to deduct any of that if it's a hobby. If it's a business, you can deduct all of those as cost of goods sold, or as any other supplies that might need to be there. All right, so that's the good and bad about those. But now, that's the bad about the hobby, good about a business. But now let's flip it. The good part about somebody claiming something as a hobby is you avoid 15.3% in taxes by not paying the self-employment tax that you are required to pay if you have your own business. So, for example, my wife is, by trade, is a physical therapy assistant. So she works on people during the day, and then sometimes on the weekends, not a lot, maybe once a month, she'll go and judge gymnastics as kind of a thing that she really likes to do on the side. She didn't have any really formal schooling for that, and just a way to make a little extra money and enjoy doing it. That would be a good definition of a hobby, in my opinion. And before you might have known about this, you could have said, yeah, that she was earning some money, so we'd have to count it as a business, and therefore taking a few of the expenses. But when it was all said and done, it's actually a better tax decision for us to count this as a hobby, as long as we meet the certain rules of a hobby, instead of counting as a business and paying this pretty big chunk of Social Security taxes that get taken out. Because not only are you paying your portion that you normally get taken out of your W-2s, and you don't really even know it, 7.65%, but you're also paying the employer's portion since you are the employer and the employee, another 7.65%. Total there, 15.3. So it can be very beneficial to claim your smaller type, it's not even business, but income generating activity to be a hobby, as in the example that I just had. So what's a hobby? You can't just claim it a hobby just because it makes a better tax decision for you, or a business because it makes a better tax, it's better for taxes for you. You actually have to meet some of the criteria. So the first one, that some of the things that the IRS is going to look at. Were you in this to have a profit-driven motive? If so, then it very well could be that could be one of the motivating factors for it to be a business. Not necessarily though. I mean, even a hobby, you hope to make money, but you might not. Either way, but are you in it because you really need the money? If you don't show profit for at least 3 out of 5 years, the IRS is probably going to look at it as more of a hobby, and you're not able to take those expense deductions like you would for a business. This time and effort, like the gymnastics example, is only once a month type activity. It's not a daily or even weekly type activity where it's pretty constant. That would be more of a hobby instead of like owning rental property. It's a bad example, but if you spend a lot of time on your rentals or whatever else it is, you paint every day, it's kind of maybe more than a hobby. If you are in a high tax bracket and you make a lot of money and you do something on the side, it's probably more going to be a hobby, whereas you don't really have a main job or it's kind of a part-time job and then you do something else on the side, and that's kind of how you help make ends meet. That very well probably could be a job status, actual business status. And then what is this activity that you're doing? Do you really like to do it, part of pleasure or not? So that's some of the things that the IRS looks at, not everything. What I want to do now is I have attached a PDF file, and I think this is a great document to go through, and it's good enough that I actually want to take the time and go through a few of the items that the IRS, what the case, I'll give you a brief overview before I open it up. The IRS is claiming that this individual should not be considered a business. He's taking a whole bunch of expenses, therefore generating a pretty large net loss. And his net loss is causing his taxable income to go way down. His wife is a high-end income earner on some board activities, doing on companies, large company CEO boards, and makes pretty good money. So the IRS is going to look at that as part of he's doing something on the side. Is he really doing it for hobby purposes, fun stuff, or is he really doing it to make money? And that's something that the court and the IRS and the individual were trying to iron out. The guy said in the example he's doing fishing, and he's saying, hey, I'm in this for a job. I'm in this to make money in my business. I'm a professional fisherman. And the IRS looked at it and said, no, we disagree. We think it's more of a hobby. Therefore, you can't deduct your expenses. So let's look at some of the pros and cons of what the court found in this case and kind of see how everything works out from a tax perspective. Okay, so what I've highlighted when you go through this is what I thought was the most important parts of this tax court case. PS is the PS, what's it, petitioners. That's the guy's name here, Steve, and the IRS is the respondent. Okay, so this guy is suing because he believes the IRS is out of line. He says the IRS, he should be able to count this as a business. And the IRS is saying, no, PS, that's meaning the individual is not entitled to these excessive business deductions because he's not really in a business. So what the court then is to decide, is he a business? If he is a business, then is he allowed to claim all of these expenses, therefore creating a net loss year after year after year, as we'll see in a minute. All right, and was he engaged in this for profit? Remember, that was one of our criteria in my notes. Are you engaged in this for profit reasons or mainly for pleasure? All right, so part of the plaintiff, the petitioner here, the guy, and they're given some background. And as I said, his wife was a high earner. As a controller, she worked on some boards and received quite a bit of good money, over $177,000, and some additional for being on the board and taking notes. So that right there tips off the IRS that this individual doesn't necessarily need to be making more money. Let's make sure he's really in it for a profit motive. If he is, it doesn't matter the income as long as you can prove that you're doing it for a profit motive. And the IRS's first complaint was saying, you know, this guy was telling the IRS that, hey, I don't have any other job. It's not like I go to another job and then I do this fishing on the side. This is what I do. I'm a professional fisherman. So he's been doing it professionally, he said, since 1999 when he started winning some money at tournaments. And let's see here. We had, this is gross income, not net. That's a big difference. So gross income, he won $4,000 in tournaments and then $10,000 in the following years. So the main years we're focusing on here is 2005, 2006 tax years. And then here's some of the other little interesting things that came up in this case. Is sometimes the tournaments would be a double person tournament. So there's two people in the boat, both can count their fish. And well, sometimes the guy would bring along his wife who would not fish at all, and she would be the second person, and he would pay the double entry fee, even though there wasn't two people fishing. So the IRS looked at that and said, are you really in this to win and have a profit motive? Because if you were, you probably would have two people fishing and not just one. The guy comes back and says, as part of his reasoning, hey, look, I have all these magazines and books on fishing, a whole bunch of them, and you know, the court has to look at that. How much research are you doing on your particular area? He says he reads 2 to 3 hours a night on fishing stuff, and he's a member of certain fishing organizations, so that all makes him look a little bit more realistic that this could actually be a real business. He's talked to certain people, including some individuals who are professionals as well, on how to do better. So that's kind of networking, learning how to do your job better. Definitely a reason to be counted towards a business. So counting some more individuals who are pros. And he wanted to find ways to get a sponsor, so looking at getting more money. So that's another business item that the petitioner was claiming. One of the biggies on the other side, though, that the IRS was quick to point out is he didn't keep a separate bank account, and that's a big no-no. If you ever have your own business, you definitely want to have your own bank account separate from your personal. That's a big way to distinguish yourself business-wise. So we come down here now, and the IRS or somebody is showing how much profit or loss he was reporting each year, and you can take a look at this category. And and this is what raised the red flags to the IRS. Every year they're seeing over $30,000 in losses, therefore coming off of their income. Remember, she had $170,000 in income, and then subtracting out this this big loss and then getting a standard deduction and exemptions, finally coming to a pretty low taxable income. So the IRS is saying, hey, you shouldn't be counting these losses. And the guy says, yeah, I can because it's my business. All right. So let's go through some of the findings. One thing about tax cases that you may or may not know is when something is the first time going through the tax case, going through court, there's never a write-up about it that's made public. The public only sees if there was an appeal done. So if an appeal is done, then the public can actually see the court documents and what the court found. So this has gone through a court of appeals. Let's keep going. You can read some of this. I'm going to try to find out some of the main items that I wanted to discuss. All right. So it's one of the things is you can't just look at one item or another in determining if this person was in it for a business or not. You have to take everything together and then make a decision. That's kind of a sum of what that's saying here. Okay, so the first one, the first criteria the court's looking for. How did he carry about the activity? And so whether the bacteria conducted the activity in a manner that would be similar to other businesses that were profitable, and did he keep accurate books? So the first thing they come across is, did he keep accurate books? And he did show that he had all these receipts. They were handwritten, so it's not nearly as good. No things were put in as evidence concerning income. Says yes, but it must have been misplaced. Not a good reason there. So, however, there's little evidence that the minimal books and records that were kept were kept for the purpose of cutting expenses, increasing in profits. And the main guy, the Fisher, stipulated that we didn't repair any for this activity. He didn't maintain a separate bank account. That's a big one. Didn't prepare any income statements to look at for prior years to see if you can do better. Since he did keep some items and did keep a record, the court found this was a neutral. I probably maybe would have not even been that nice. If I was the court, I would have said this was for the IRS side. So the third, does the petition, here the second one, does he carry on this as the same manner as others? And this sub-factor favors the respondent, that being the IRS, that not really. Does the petitioners change operating procedures? And let's keep looking. I'm not going to get hung up on some of these. I found that one to be neutral. Less than desired, his financial record keeping. All right. He certainly engaged and had extensive study with lots of things, did lots of reading. He's a skilled fisherman, winning at least 2 tournaments. So they favored the fisherman for this case, for criteria number 2. Criteria number 2, the expertise of the taxpayer. So he does have some background in this area. So number 1 was neutral, maybe favoring the IRS. Number 2, the court favored the fisherman. Number 3, the time and effort. The IRS doesn't even challenge this one. They say we concede it. Yes, that one would go to the fisherman. He did put quite a bit of time and effort into this activity. So 2 for the petitioner, 1 maybe for the IRS. The expectation that the assets used in the activity may appreciate in value. The guy admitted that he doesn't do anything with depreciation, and he knows that they're probably not going to increase. So this would go towards the IRS. That's what the court says. I skipped through. I skipped number 5, goes to the IRS. So the IRS is catching up, even maybe going ahead a little bit. Taxpayer's history or income with losses. So this is again seeing if you're in the profit motive. He says that this was his first couple of years were part of the startup. And in the startup business, it's pretty common to have losses. That's true. It's a fine argument. The court said the 5 years that he has been going as a startup is not excessive. Therefore, I think they called this one neutral. Yeah, they said you're making a huge loss, okay, but it's still in the startup, so we're gonna nobody wins that one. Call that one a tie. The fishing has not made any profits. Notice the word real. The court tried to put a little humor in here. The court has previously found that mere aspiration and qualifications to win cash prizes does not mean the activity was engaged in for profit. So just because you wanted to make it big doesn't mean you actually did make it big. The court did say, yeah, you wanted to make money, but doesn't mean you necessarily did, or were even going to at any time. So the IRS won that rule. The financial status of the taxpayer, they are in a highly higher bracket. So this one went to the IRS as well. As you can see, this one was neutral. They win a whole bunch of things. And what it came down to, I'll just give you the final verdict, was the court ruled that this individual should have classified this as a hobby, but he should not be penalized for counting it as a business, because there were enough reasons. The taxpayer did have a reasonable doubt or reasonable enough assumptions to claim that it could have been a business. So the IRS isn't allowed to penalize him, but he does need to show these activities as hobbies and pay the back taxes, if any, to show that he doesn't get to take all those losses and actually have to claim the income. Okay. I hope that you got a little something out of that, determining if something you ever do as a business or a hobby. I know I did, and I wanted to take the time to go through it because I thought it was pretty important. If this is going back to my notes here, one of the things we really look at a lot in our payroll class that I offer in the summer, I think it's a good summer class, is the difference between, do you recognize your employee as an actual employee, or are they merely an independent contractor? If you count them as an independent contractor, it's a lot easier for the business, for one, and it's cheaper. If you count them as an independent contractor, you don't have to pay the Social Security and Medicare taxes, also known as FICA, so you get to save 7.65%. You also don't have to pay them and take out their withholdings, like federal and state, and Social Security and Medicare on the employee's behalf, take it out, and then pay that to the government. You don't have to pay anything except their gross wages. Makes record keeping a whole lot easier on a business if you hire somebody as an independent contractor. But you can't just hire somebody and call them an independent contractor because it's easier. There are certain rules that have to be met. One step back here, just because you, on the 1099, if you ever work for somebody and you have a little side business, just because you don't receive a 1099 miscellaneous from them doesn't mean you get to take and not count that as income. It's a common misconception I hear a lot. Somebody will, maybe they're a heating and air person, and on the side they'll help their friends out. They'll do some stuff, and their friends will pay them $100 or $500, whatever it was, and they just think that's free money. In a tax law, there is no such thing as free money. if you provided somebody a service and they paid you, even though they're not going to give you necessarily a 1099 or they don't even meet the criteria for issuing you a 1099 miscellaneous, you still have to count that as either your own business or a hobby income, which, you know, for like my wife's gymnastics thing, that would be really nice if she earned $1,500 a year and we just got that money and never record it anywhere. But since I know better as a tax person, we can't do that. You have to record any money that you earn, even though you don't get any receipt or anything for it. So who is an independent contractor? Who's an employee? Some of the questions that you would want to ask yourself if you're a business or if it's yourself and you are working for somebody. Who controls what the worker does and how they do it? One of the key things here is how it's done. Say you work for Comcast and you're considered an independent contractor. Can you go in and take the jobs as you want, or and do they kind of teach you maybe a little bit how to do an installation, but however you do it, like however the most easiest for you. Do you get to pick which assignments you're going to do, or are you kind of told which ones you're going to do? That's the difference between an independent contractor who picks and an employee who's told. The financial controls. Is there a chance that you may have a loss because you spent more time on a project than what was allowed to be built? If so, you're an independent contractor. If you're paid per hour and it doesn't matter if it took you 2 hours or 10 hours, you're still going to get paid the same hourly rate, then you're an employee. Do you have your own tools, basically? How much investment have you had to put forward? Do you have your own truck? Do you have your own whatever it is? Or do you maybe rent it? If you rent it, you're maybe more, well, if you rent it, then you're still an independent contractor. Does the employer actually provide you something and reimburse you for gas and different things? How they're paid, if you paid a flat fee per job, again, that's the 2 hours versus 10 hours, you could easily have a loss if you worked there for 10 hours and it was only a 2-hour job. And then, do they provide you with benefits, health care, any retirement? That's going to be an obvious example of an employee. It's there's a case between somebody, if you want to you can copy and paste this into Google and look up this court case about an example of an employee versus employer court case to see what should this individual have been. Okay, so when you get income from your business, what are you supposed to report? Well, of course you're going to report anything that shows up on any Form 1099 miscellaneous that you receive. And that's usually going to go there in box 7 where it says non-employee income, because they're not considering you an employee. Sometimes companies make a mistake and put it on line 3, other income, but generally you'll see it there on line 7. Companies, note this is companies, if you make over $600 per year with them, if you have earned $600 and they paid you, then they are required to fill out a 1099 miscellaneous and send it to you and to the IRS, a copy. Note though, if it's an individual you're working for, even if you made over $600, they don't have to fill out a 1099 miscellaneous. It's only companies that need to. So if you go do a work for the lady down the street, she pays you a total of $1,200, you may not get a 1099 from her, you probably won't. However, that is considered income and you would have to report it. If the IRS would ever audit you and they say, hey, where'd this $1,200 come from? How'd you get it? You might get in trouble there. So that's what I noted here, number 2. All income is considered income, even if you don't get a 1099 miscellaneous to actually where the IRS gets a full record of it. Because anytime you get a 1099 miscellaneous, the IRS got a copy of it too. So they're looking to make sure you reported that. Okay, so that was pretty easy on income. Expenses is where you really start breaking things down a whole lot. First part is ordinary and necessary. And basically is, would a typical business person in your with a similar background, similar expertise, have the same expense as you? So is it necessary for you to fly first class versus business class or coach? That would probably, first class would probably not be a necessary or ordinary expense. If you paid $1,000 for a first class ticket when a coach ticket only costs $500, you could still deduct the $500, just not the excess $500 that you paid for first class. Notice your salaries must be reasonable. A company cannot deduct more than $1 million for any one employee. They can pay them more if they want. They just can't deduct more than $1 million. So how companies get around this is they provide a whole bunch of freebies, or not freebies, but they count it as commissions, or they count it as they put more money in retirement plans, pay for health care, pay for a lot of other things. Therefore, they are allowed to deduct those. But base pay, you can't deduct any more than $1 million. But if they set some pretty low bar things to reach, say the company, as long as they had profits of $6 million, well then you get a commission. CEO and CFO, we're going to give you 10% of that. And we're going to give you 10% if you make another $6 million. So your money could really rack up pretty fast. Again, the IRS counts that as a commission, therefore there's no limit there. You can put more money, as I said, retirement plans, medical plans. Expenses that are not allowed for tax purposes. If you provide somebody a kickback, you're paying a fine, a penalty, even though they're considered normal in that course of business for you to pay a fine, pay a penalty. That's just in that line of work. You can't deduct it. You can't deduct something that you specifically do and only do for tax purposes. It needs to have some type of business reason besides, as I say here, saving money on taxes. There are some things out there that people are pretty creative and do, and the only reason they do them is to take money off on their taxes. If you own a legal business, you are not allowed to deduct any of those cost of goods sold expenses. So if the IRS, this is how the IRS gets a lot of drug dealers off the street, is one of the things they charge them with is tax fraud. And that's how they got, I believe it was Al Capone and a few others notorious bank robbers or mobsters, is they got them on, well, we got you stealing money, and even a bigger penalty here is you didn't report that money to the IRS. Therefore, you and they can't argue that, well, we had all these expenses by selling our marijuana. Well, they're saying, nope, can't count marijuana as an expense. And if you donate anything to a political, not allowed. Transportation, travel. All right, so what are you allowed to deduct if you have to go somewhere for your business? So that's what this whole section is going to deal with. All right, so we're going to break this down into two sections. Transportation we're going to look at first, and that's for daytime, for day-only little distances that you have to go. Travel is going to be when you're gone overnight from your main tax home. So transportation is if you have to go somewhere to another client, but you're going to be back home by the end of the day. You don't need to spend the night anywhere. It could actually be using airplane to make a trip over to Cincinnati or down to Memphis and come back the same day. That does happen sometimes. So you could actually have some airplane travel, some airplane expenses that are actually considered part of the transportation. Meals and lodgings not included. So if you go somewhere and even though you're gone all day and you have to eat out, you're not allowed to deduct any of those expenses for your day travel where you're back at home at night. Commuting, not allowed. So back and forth to your principal place of work, you can't deduct any of those miles. But there are some exceptions, especially for those who work from home. If you work from home, then you don't really have a specific office you're going to. So anytime you do go somewhere for business to visit a client at their place of business or at their home, then that is allowed, that you can take a deduction. So that's what this is. So travel between your home and a temporary work location, like a client's. That's kind of what these first two are, really. Even if you do have a primary workplace, but you go to a client's house instead of your workplace, that would be considered a deduction. That would be considered an allowed travel. So your primary is working at Ivy Tech, but for the day you go and teach for Ivy Tech at some other place. That's not a good example. Ivy Tech's not your own business. So you do have an office. Say you're an accountant. You have an office downtown wherever, what city. But instead of going to the office that day, you go to the client's house. That mileage you would be able to deduct on your taxes as a mileage deduction. Actual cost versus standard mileage, you're going to find that I'm not real good at percents, estimating, but at least 75%, maybe higher. At least 75% of the time, using the standard mileage rate is going to be easier and actually be more effective for cost reasons. You're going to get more of a deduction. The IRS in 2014 is allowing 56 cents per mile. And that includes all of these normal type items that you're going to pay for, and even including things you don't pay for, like depreciation. So if you take the standard mileage rate, you wouldn't take any of these as a deduction. You would just take 56 cents per every business mile that you have included. And those would include some of these going to clients' houses. Notice the one of the exceptions is parking and tolls. Even though you do take the standard mileage rate, they do allow you to tack on to that, whatever your standard mileage rate is, to tack on any parking and tolls fees in addition. Okay. One of the rules that the IRS mandates is you can't switch back and forth. So if you want to use standard mileage, you have to use it in your first year that you own that vehicle. Otherwise, you have to use the actual costs. And you'd have to keep all your gas receipts. And then keep track of your oil changes and keep track of your mileage to be able to determine, all right, if I use my car half for business, half for personal, well, the IRS is going to look at that and say, well, just because if you used it half for business, half for personal, then you can't deduct all your gas. You can only deduct half of it and only half of your oil change. Travel, okay, so this is for your overnight stays. You can deduct all your costs as long as they're ordinary and necessary. Stay overnight. Better keep most, if not all, of your records, so all of the receipts, so it's a little bit more cumbersome. Notice here that meals and entertainment only deductible up to 50%. So if you spent $10 on a lunch, you can deduct 5 of that. Entertainment's the same way. And in addition, the entertainment has to be connected with business somehow. Either you had business right before or right after, and then there was an entertainment at some point near that meeting that you had business discussions. And you better keep documentation on this. If the IRS would ever audit you, they would want to say, hey, you had entertainment. Show me that you had business, and so you would keep a little journal. It said, met with client 7/14/2014 and discussed this and this and this with the client, and then went to a Major League Baseball game. That would be considered okay, and you would be able to deduct 50% of that entertainment cost. All right. And let's look at this example. Kind of go through some of the items. If you were, when you're looking at this, you see that this individual brought in $40,000 income, and then we have this car, 70% business, 30% personal. So what we'd have to do is add up all of our expenses for our first year: oil changes, insurance, depreciation, tires, parking, and excuse me, let me phone call. Accounting department, it's Kevin. Okay, so starting back up when we left off, you'd have to figure out here, we got total miles and business miles, so what percent, and if you do the calculations, it's 70% business, so 70% of, not including parking, you include all of that, but 70% of all of these guys we would be allowed to deduct. Or business mileage, 10,000 times the 56 cents per mile. And then we've got these other costs that we're going to look at, all of them. Lodging, fine, food, that's going to be one, but don't let us trip it up. Remember, food, you're only allowed 50%. Airfare is fine, taxis fine, and so a couple other, these are non-trip things, but things we had throughout the year. Supplies, fine, deduction, phones okay, utilities is fine. Self-employed health insurance, can't deduct that. That is something that has to go on your 1040, on the front side of the 1040 as a deduction. It is not allowed as a deduction for your net income, and that's a bad thing, I think. I think that's unfair for self-employed people, because if somebody who works as an employee at a big corporation and they pay health insurance premiums, that doesn't get included in their wages, and therefore it doesn't get included in their Social Security or Medicare for tax purposes. But for somebody that owns their own business and pays their self-employed health insurance, they don't get to deduct that cost on their business income. Therefore, they will pay Social Security and Medicare taxes on that $1,200. They do get to take the deduction, $1,200, for federal income tax purposes on the 1040, but not against net income. Okay. So we're going to go through that in Okay, so let's look at the answers for this exercise A. We'll see if you got the same thing. So when I added up all the car expenses, well, first it may help is I like when I'm doing this in classroom, I have the students get out a Schedule C so you can actually see where things go. So let's get on our book and turn to the front part of Chapter 6. And you'll see your Schedule C there. At the top, you put in, of course, your business name, and there's a code. You usually have to look that up either on the tax form instructions, or you can look it up online as well. But you do need to usually put in the code. For our purposes, I'm not going to require that. Most companies in Part F there are going to use the cash method. That's by far the most common. For our purposes, we can skip down now to the income. We had gross income there of $40,000, so that's what we would put in there in line 1. And then this car and this car expense, so we go down to line 9, part 2, and we would want to put in the higher number. We could either put in $23.70, which again I took 70% of all of my costs except parking. Parking, you can take all of it, as long as the parking was for business. So $21.70 was 70% of all of these costs, and then add in another $200. So compare $23.70 to the business mileage at 56 cents per mile. Notice it's way over. So by far the standard mileage is the better option here. 58.80, and then we can add in the parking. So we would put on line 9 of our car and truck expenses, not both of them added together by any means, but just the $6,080 as a car and truck expense. So that $23.70, we wouldn't even need to keep those receipts in the future. Just keep track of your miles and your total miles. Travel, we can deduct everything fully except the meals. So in line 24A, I can put 700 there, and then put $60 for 24B, half of my meals. And then notice I can list some of these other items as well. And when there's more than one thing, you can do a split line item. You can list different things, and when you get to the tax program, we'll probably look at that next week or even the following week, since we don't have a tax return due for a couple weeks. But out to the tax return, out to the side of, say, office expenses, because lots of things could go there for line 18. There's a little hand. It looks like it's using a pencil, and then you can click on that and type in numerous different specifics and then have them add it all up to see what your office supplies are. And so then next year you can look, what did I count as office supplies? We can count business insurance. You just can't count the self-employed insurance. Notice it does say that there in line 15. Insurance other than health. So when I added up all of our expenses and then subtract that from the $40,000, I would report net income of $28,000. That's what's going to get added to my tax return, and that's what I'm going to pay self-employment tax on. So if you now look at the 1040, so go back to the 1040 on, let's say, page 2-4, the back part of the 1040. Line 57. Line 57 is the self-employment tax. Now you would follow this schedule. It says there, Schedule SE, but in a sense, what it's going to be doing is taking $28,254, and you get, there's a few little calculations, but for the most part, it's taking that full amount and then multiplying it by 15.3%. Your portion and the employer's portion of the Social Security and Medicare taxes. So that's a big thing. And then it lumps it right there in line 57. And then I again mentioned that the $5,000 self-employment health insurance goes to the 1040. And while we're here, page 2-3, the front side, notice line 29. Self-employed health insurance deduction. So that's where that $5,000 would go. So you get to deduct it and not count it for taxes on your federal or your state, but you still are paying taxes on that $5,000 for self-employment, which is not fair in my view. Okay, let's keep going. We got what we're going to get to today is up to depreciation or thereabouts, and we're going to spend the rest of next week on depreciation. So a few more things I want to touch on today. Go probably about 10 to 15 minutes here. If you combine a business and pleasure, then it's kind of iffy on if you get to deduct some things. If your travel is over half for business purposes, then you can deduct your transportation to and from. If it's over half for personal, you can't deduct that transportation, like that airfare to get there. So that's a biggie, and you'd want to have that in your head and when your plans if you do combine a business with a personal trip. And then notice how they calculate weekends. If your business purpose requires you to be there on a Friday and a following Monday, you can actually count the Saturday and Sunday as part of business for your, you're there for business purposes even though you may not be doing business those days. If you're there for primarily pleasure, that means over half the time is pleasure. You can still deduct the days that you're doing business and any business costs. You just can't deduct the travel to and from there or any lodging. Any of the days you can't deduct lodging that you were there for primarily personal reasons, except on the weekend. If you're there over the weekend because for business purposes you need to be, then you can deduct that the weekend. I'm going to skip down to the part 3 here in the per diem. If you're self-employed, it's mainly easiest to keep track of your meals instead of, especially if you have a lot of business trips and they're overnight, and so therefore you can take the meals deduction. It's to do this per diem method, and you can look up online per diem. And what the per diem federal rate is, $46 a day, or you can actually go on and find specific for that city, but it's probably easiest just to use $46 a day. So you would be allowed to deduct $46 per day, or that's how much you would be considered of spending, so you would only deduct half of that. But you would be shown as spending $46 per day in meals and incidental expenses, so not having to, that includes tips and stuff. So you could write down, I spent $46 on each day business for meals, and no problem. And then you would need to keep track of your lodging, not have to keep track of all of those meals. Okay, switching gears just a little bit, use of the home office. So quite a few small businesses, they don't go out and rent an office, they use their home. And there's certain criteria that need to be met before you can start deducting any costs out of your home, like maybe a little bit of depreciation for one of the rooms you use, or the utility for that room, or the phone that comes into that room. You can deduct some of these things. If you're self-employed, you're going to show all of this on this Form 8829, home office. And the IRS and Congress gives us 3 scenarios where it's okay to use a home office. If it's not, if you don't fit into one of these 3, then it's a good chance you won't be allowed to deduct home office expenses. So the sole proprietor, somebody who has their own business, uses their main office as their primary place for their business. So you don't have any other. Basically what they're saying is if you have your own office that you rent somewhere in downtown in the city, and then you have a little space in your home as well, that wouldn't count just for this rule, as long as you didn't meet another factor, which is number 2 or 3. So if you had 2 offices, one that was your main office and then one you used at home just to do some small stuff on the side, that's not allowed. What it would be allowed is if that office was your only office. The other one of the exceptions then is if you do have a main office, so like you're a doctor and you have an office in the hospital, but then some patients do come to your home, so you need to keep up a home office in appearance and have all the other amenities that need to go in there. That's okay, as long as people are coming on a regular basis. The third item that's okay, as long as, these 2 maybe don't meet, but if you have a home office that's separate and people come there on a continuing basis, then that's okay as well. Again, the main things that you have to do is you use these areas in your home exclusively for business. You do not lounge in those places after business hours. You basically have a door and it's locked. You don't use that part of your home for personal purposes. If the IRS sees a lot of toys in there, computer games, then they're going to say that's not deductible for a home office if they would ever come and audit you. So calculating deductions for your home office. Any direct costs are allowed dollar for dollar. So a direct cost would be having an installation of some specific equipment in your home office that you only use for business. You're not using that for any personal purposes, so you can deduct all of it. Or you need to put in some furniture in a waiting room, at your home office for people to wait. That would be direct cost. Indirect is something that you pay, but you have to split out the bill, and there's no really good way of doing it, so you do it by square footage of your home. So when you pay, unless you have a separate line for like electricity, and a separate line only feeds your home office, then that would be a direct cost. But any other that you just have one electric bill for the whole home, you're going to have to split that up and say my home, in this example here, I would be able to take 25% of my electric bill and deduct it as a business expense because I use 25% of my home for business purpose. Same with any other mortgage. You pay a mortgage, you can deduct some of that, some of your interest. That's just interest. Real estate taxes, you're allowed to deduct as well, a portion. And then there's an order that you have to take your deductions. You can't just take them however that you want. Direct cost, percent of mortgage and interest, there's a reason why that's in there. And then indirect costs, and then finally depreciation. Big couple rules to remember. Home office deductions cannot have your net income go below 0. So if you have a net income of 500 and then you have home office expenses of 1,000, you can only use 500 of that and get you to 0, but not below 0. And then obviously this one, if you use it for both personal and business, you can't deduct anything then. So I have this second example to look at and to calculate what's allowed to be deducted and what's not for the home office. Notice here, expenses before home office. So we're still left with 40,000 minus 18. I have 22,000 left that can be spread out to my home office expenses, so plenty. And you can look at my answers that I have posted online for those. Example C, notice our revenue is only 22 minus the 18. So now we're only down to 4,000 that we have left to use before we get to 0. So we'll have to see what we're allowed to use and what not. The last thing that I wanted to touch on is business gifts. If you give a gift in your business to a client or somebody, you're allowed to deduct up to $25 per year per donee. $25 isn't very much to take as a deduction. Most gifts are sometimes a lot more than that, but you're only allowed $25. Any gift to a supervisor would not be deductible at all. All right, that's a good place to stop. We're going to continue on with depreciation next week and see how that affects. What I would do is get started on your homework and do as much as you can that's not depreciation related. Do all the other multiple choice and any other questions. And you could submit that to me, or we'll go ahead and wait till next week. Either way is fine. But make sure you do look at that VITA and get those. That's going to take you a while. That's not going to be a one sitting type deal for most of you. So go through that and use your Tax Act software to complete the forms, and hopefully you'll be able to submit me that basic certificate from VITA. All right, we'll close out here. Email me with any questions you have like usual. I'll see you next week.